Sure. Hi, nice to be back. Well, I mean, it's exactly what you say. It's time for the market to move beyond, to move past this obsession around central bank communication, around deciphering through the nuances. And essentially, the last few weeks and months have taught us 2 points. Point number one, exactly as you say, it's time for investors to stop piggybacking central banks. The Fed has made it quite clear that they're shifting gear finally away from Wall Street to Main Street. The Fed has done enough. It's propped up asset prices. The S&P is up 50% since 2019. But the second point, interestingly, and I think most importantly, is that real negative yields are here to stay. Even if in a very hawkish, with a very hawkish behavior, the Fed is to start hiking in March, 25 basis points every quarter. By the end of 2023, we're still below the 2.5% interest rate level seen in 2018. And most importantly, we would still be below core inflation.
So, Anneka, if we're not going to deploy the Fed put or the Powell put as it would be these days versus the Bernanke put back in the days, what do you do? What's the strategy this time around?
Yes, so that's it. So what do you do? It's time for investors to step up. It's time to be proactive and to essentially do more work rather than just buying the index, to really look beyond where can one achieve yield in yet another period of yield-seeking environments. And I think there, we at Van Lanschot Kempen believe there are two opportunities there. I mean, clearly the equities market can offer that yield. Clearly the equities market, especially with specific stock selection, can offer that inflation protection with high quality companies, with a moat to their business models, with pricing power. And particularly in Europe, Europe has been the underexposed area of the markets for a very, very long time. And there's almost a fatigue of when will this European catch-up trade happen? Well, what did happen last year, if you exclude the US, because obviously US is filled with tech names which did very, very well. If you exclude the US, actually MSCI Europe versus global indices, that was actually the best outperformance in 20 years in Europe. So it is starting to happen. And I think with the European backdrop, there's a few things happening. There's more sort of momentum of economic growth opportunity. Q3 GDP is still below pre-pandemic growth levels, which is fascinating. And actually, you could argue it could be a couple of percentage points higher because of productivity growth, etc. But the other thing which is very interesting about Europe is the valuation. The valuation of European equities are sticking out like a sore thumb. And I think that's something which will certainly gain attention, especially because talking about the central banks, the dovish hawk out there is the ECB. They can't afford to be too aggressive because look at the European bond markets, look at the fragility, look what happened last time with the European sovereign crisis. They can't afford to repeat that era again, at least not for now.